If year-end feels like month-end but with landmines, you're not crazy. One missed accrual can wreck your tax return tie-out. I'm a US CPA and I review messy year-ends for a living. What you learn: the order to close year-end without rework, the 3 reconciliations that matter most, how to document it so reviewers don't ping you, a clean year-end accounting checklist. Step 1. Lock the cutoff. Match bank activity to the right year. Example: client booked a 1-2 deposit into December. Profit was overstated. Fix was simple: move it, note it. Step 2. Reconcile cash, then AR, AP. Don't tie reports to vibes. Example: AR looked fine until we found a $18,000 credit memo sitting in 2023 dated 2024. Step 3. Accruals plus prepaids. Think earned versus paid. Step 4. Payroll plus contractor filings. Make sure wages, taxes, and benefits actually clear. Step 5. Fixed assets plus loans. New debt, new equipment, update schedules. What reviewers look for: cash rec equals bank statement ending balance. AR aging, old items explained, credits applied. AP, bills versus expenses not duplicated. Big P&L swings, flux, have a reason plus backup. Balance sheet accounts aren't junk drawers. Docs reviewers expect: bank, CC statements, aging reports, loan statements, payroll summaries, asset schedule. Quick checklist recap: reconcile all bank CC, AR aging reviewed, AP aging reviewed, accruals posted, prepaids true up, payroll tie out, 1099 W2 prep items, loans reconciled, fixed assets updated, equity distributions reviewed. If this sounds like your close process, you're not alone. Drop a comment with the one account that always trips you up. Like plus subscribe for more. If you need a structured way to run account level review and track findings to resolution, that's what review first systems like Xenett are built around.